Hey guys, the Investment Panda here with another episode. Today we're going to talk about how to begin investing in stocks or equities with $1,000. So I already assume that you have a traditional brokerage account or a retirement account open with $1,000 in there, but you don't know what to buy or how to buy it. So the first thing that you need to ask yourself is the type of investor that you want to be. Do you want to be somebody who actively trades and analyzes stocks and picks stocks depending on strengths and weaknesses or market rotations? Or do you want to be a passive investor and all you want to do is just add money into the market and let that grow so that by the time you retire or at a later age, maybe even before retirement, you can utilize that money to live off of? So that's the first question. If you want to be a passive investor and you want to invest, just add money into your account and let that grow, my suggestion is that you want to buy ETFs or exchange traded fund. These ETFs follow and measure the stocks that are in major indexes like the S&P 500 or the Dow, Russell, etc. So by nature, it's already managed, the stock's already chosen, and it's managed by someone else. So not much work for you to do except to keep putting money into it, keep buying these over time. If you want to be an active investor, you want to build your own portfolio, then you want to invest in individual stocks. That's what I do. I invest in my own stocks, I curate my own portfolio, and for fun, I compare it against the S&P 500. Once you determine the type of investor that you want to be and how much time you want to spend into this, the second question is, what is your strategy? Do you want to invest in value stocks, in dividend stocks that will give you income, or in growth stocks that will show a very quick rise and very quick growth in your portfolio? There are a multitude of strategies, but we're going to run through a few of them today so that you get an idea of what's out there and what you can do. Some of the most popular strategies include investing in the S&P 500 itself. So the S&P 500 is an index that measures the returns and the risk of the 500 biggest companies in the United States. So obviously, by investing in the S&P 500, you're going to get diversification because it includes companies from almost every industry and every sector. Also, you're going to be investing in large cap stocks, meaning these are mature and established, very large companies that operate in the United States and most likely worldwide. So you get that diversification as well. What you may not get a lot of in investing in large caps is growth. So because these are more mature and larger companies, they may not show the same growth that other smaller cap companies would, like a small cap or a mid cap company. Nevertheless, the S&P 500 is the state-of-the-art benchmark that everybody in the financial industry chooses to follow and to compare their investments and their returns against. When everybody talks about the market, we're usually talking about the S&P 500 and how the S&P 500 behaves in the last day or in the last week. The S&P 500 is a great investment. It is a great way to invest, and it's backed and suggested by many known in the financial industry like Warren Buffett. If investing in the S&P 500 sounds really good to you because of its diversification, the fact that it's composed of all large and mature companies, safe companies, and the global footprint that you get from these companies, then a good way of doing it is by investing in a Vanguard ETF called the S&P 500 or VOO. VOO is an exchange traded fund built by Vanguard, and what it does is that it follows the performance of the S&P 500 almost identically. So if you want to invest in the S&P 500, investing in the Vanguard S&P 500 Index Fund, or ticker symbol VOO, is a great way to do so. If you're younger and you have more time to invest, then a strategy that may be good for you is to invest in growth companies. Growth companies are those that are on a high trajectory. They show very large increases in sales and sometimes in their earnings. Many of these companies actually have negative earnings, but they show a lot of potential. and they're growing exponentially year after year. The prices of these stocks soar very, very high and usually beat the S&P 500, which is composed of more mature companies who have already grown at their level of maturity. Growth companies are a great way to invest, and I would suggest that people who are younger invest in these companies. Growth categories are usually composed mostly of tech companies that are showing a lot of growth over time. You can find Facebook, Amazon, and Tesla in these benchmarks. One of the drawbacks with growth is that these companies provide a high rate of projected return, but also provide more risk to your portfolio, as many of these companies are still in the growing stages and may not be making any profits yet. So they may be showing negative earnings year over year, which means that they have to invest, they have to finance their operations through more stock offerings or getting more debt. So that is one of the risks. The more debt that a company gets, the riskier the company, as they become liable to pay all of their lenders that debt. And if they can't make enough money in a short amount of time to pay that debt, then they can get in trouble and go bankrupt. If a growth strategy sounds good to you, a good way to invest in that is through the Vanguard Growth Index Fund, or VUG. Another strategy available to you is investing for income. So investing in dividend stocks. If investing for income is a priority for you and your investment strategy, and you want to get to a point in your life where you're collecting passive income, sort of like a rent does, where it sends you a paycheck monthly and you live off of that income, you should consider buying and investing in dividend stocks or in dividend ETFs. A dividend is a small cash payment made by a company to its investors as a thank you for holding and investing in their company. I really like that methodology and that way of thinking because everybody needs cash, and it's a great way to invest in companies and keep investing and yet get some cash back so that you can pay off some expenses and hopefully at a point in time to live off completely from your dividend income. So one of the advantages of investing in companies that pay a dividend is that you get a cash payment and you don't have to sell your shares to get money and live off of that money, live off of your investments. One of the drawbacks of investing in dividend companies is that usually these companies that pay a high yield or enough for you to live off of are companies that are in a more mature state, and they're not going to show much growth in the future, but they're pretty stable. I usually hold the dividend stocks as a way of investing safely and with more peace of mind, as these are established companies who have been around for a long time. They're very large usually, and they pay me an income periodically that I can use to either reinvest, pay some expenses, or in the future live off of continually. Some of the drawbacks of investing in dividend stocks can be limited amount of growth, or growth that's not going to accelerate or show the same amount of returns as would growth stocks or maybe even the S&P 500. The reason for that is that these companies that give a high dividend yield or cash payments to its investors are already at a mature state. So the security that you get in investing in a very mature company and its stability is also has a drawback because it's not going to offer the same rate of return or growth that a growth stock like Tesla would. A good way to start investing in dividend stocks is through the Vanguard High Yield Index Fund, or VYM. VYM follows a benchmark of the biggest high yield and most established companies that give high dividends. VYM follows a benchmark that measures the risk and the rates of return and dividend yields for some of the top dividend companies. VYM currently gives about over 3% return, and part of its 10 top holdings include Johnson & Johnson, Bank of America, JP Morgan. Lastly, If you want to invest in the entire investable stock market, small caps, mid caps, large caps, growth, value, yield, what you want to invest in is the Vanguard Total Stock Market Index Fund, or VTI. This vehicle measures the return and the risk from all investable stocks and all of the major indices. Therefore, this gives you availability, this gives you access to invest in every single company that exists. These are some of the ways that you can start investing in the stock market and start building your own strategy and your own approach to investing. Any of these ETFs are a great starting point for you to begin investing for your future. Your strategy doesn't have to be held down to only one category. Remember that you can build a strategy that is all encompassing and perhaps has 30% in dividend yield, 40% in growth, and change that as you grow older. Now, if you're somebody who wants to be more active and closer to their portfolio, and you want to curate your own portfolio and compete against the S&P 500, then individual stocks are for you. The advantage of investing in these ETFs is the diversification that you get by investing in them. Because these measure and track large indices with many companies, if a handful of companies don't do really well, it won't really bring down the rest of your portfolio. However, if you invest in individual stocks and you can pick them well, your returns can be exponential as compared to the returns that you get in the ETFs. Also, investing in individual stocks is a lot of fun. So if investing in stocks and educating yourself and investing in different companies is something you like, then that's an opportunity for you. I currently hold 2 investment accounts. One of them is my retirement account, which with my corporate job, it's a Roth 401k, and I'm invested in 4 different mutual funds in there. I'm invested in large growth, mid-cap growth, small cap growth, and then an international growth. I also have a brokerage account with Robinhood that is a taxable account, and there I invest in dividend income stocks. In my normal brokerage account, I invest in individual stocks. I have a little over 30 stocks, and all of them pay a dividend. Now, I've categorized those in separate groups between high yielders and growth stocks. Yes, dividend stocks can also be growth stocks. I'll be talking more about that later in another video. And I decide which companies I invest in and how much I invest in. I take a lot of pleasure in building my own portfolio and in projecting different scenarios and managing the portfolio as such. Another pleasure that I get from investing in individual stocks is that I feel like I actually own the companies. The companies that I buy shares in, I actually feel like an owner because I hold those shares. And it's a different feeling than when you're investing in ETFs. Although technically you're an owner of those shares, you don't hold the shares yourself, but they're somewhere else. And I get that sense of satisfaction of being an owner of these amazing companies in my normal brokerage account. Whether you choose to invest in ETFs or individual stocks, or you decide in investing in a growth strategy versus a dividend high yield strategy, congratulations. You're already setting yourself up for success and for growth and for financial freedom in the future. You're already ahead of so many other people. If you'd like to see more videos, more research on our portfolio, leave a comment below, and please don't forget to smash the like button and to subscribe. See ya. Rewind.